Welcome to the Deep Dive. Today, we're digging into the latest earnings call from FuelCell Energy. We'll try and cut through the noise and really focus on the strategic shifts and, the financial performance that matters.
That's right. We're looking at their Q3 fiscal year 2025 results. And it's a pretty fascinating look at a company in electrochemical tech, right? Big scale, always on power, emissions management. Yeah. All happening right in the middle of this huge energy transition.
Exactly. So our mission, as always, is to pull out the most important bits for you, find those aha moments, and just give you a clear shortcut to understanding what they're doing strategically and how the numbers stack up, especially with how the market reacted.
Okay, so let's unpack this. What were the headline numbers that really got the market's attention straight away?
Well, FuelCell Energy reported revenue of $46.7 million. That significantly beat the consensus estimate, which was around $43.9 million.
Okay, so a nice beat there.
Yeah, a 6.6% positive surprise, and maybe more impressively, a 97% year-over-year increase. That's pretty remarkable.
Oh, okay. And earnings. On earnings, the adjusted EPS came in at a loss of 95 cents. But that was also a beat. Consensus was expecting a loss of $1.59.
Right. Now, I did see the GAAP EPS, the generally accepted accounting principles number, showed a much deeper loss, $3.78. Lots of non-cash stuff in there, I gather.
Exactly. Big impairment charges from restructuring mainly. But like you said, investors seem to look right past that GAAP number.
Yeah, the stock reaction was very positive, wasn't it? Seemed like a strong signal of belief in maybe the underlying improvements or the strategy.
Absolutely. The stock closed up, was at 22.75% on the day, finished at $5.18. And the volume was huge, about 10.2 million shares traded, way above its average. Mm-hmm. And we even saw reports of unusual call option activity. So yeah, definitely underscores that positive sentiment. The market was focused elsewhere.
Okay, so strong revenue beat, positive market reaction despite the GAAP loss. Let's dig in. Where did that meaningful revenue growth actually come from? What were the drivers?
A big piece was product revenue. That hit $26.0 million, mostly module deliveries to GGE over in Korea, and also some revenue from Ameresco.
Okay.
Service revenue also ticked up to $3.1 million. That was driven by those long-term service agreements, the LTSAs, again, with GGE.
Got it.
Generation revenue brought in $12.4 million, and then advanced technology chipped in $5.3 million.
Wow.
That segment includes things like the ExxonMobil collaboration and the Rotterdam work streams.
Right. And management kept hitting certain themes, didn't they? I heard meaningful revenue growth a lot. Talk about the core carbonate platform efficiency being above 50%.
Definitely emphasizing efficiency.
And how restructuring is lowering costs and sharpening their focus.
Yeah, which brings us right to those restructuring activities. You mentioned the charges. The company booked $64.5 million in non-cash impairment expenses. Yeah, and another $4.1 million in actual restructuring charges. The whole point, they say, is to right-size the operations. And importantly, management's aiming to cut operating expenses by 30% on an annualized basis compared to fiscal 2024.
Okay, a 30% reduction target. That's significant. So what's maybe a bit surprising then is that the improved gross loss and the adjusted EBITDA happened despite those big one-time charges.
That's exactly right. The gross loss actually improved. It was negative $5.1 million compared to negative $6.2 million the year before.
An improvement, still a loss, but better.
Right. And adjusted EBITDA also improved. Came in at negative $16.4 million versus negative $20.1 million last year. Yeah. So yeah, it points to some underlying operational improvement. And that seems to be what the market picked up on, kind of looking through that bigger GAAP loss.
So that leads us to the strategy. This is where it gets really interesting, I think. The market excitement clearly latched onto a key theme. What was the big picture message from management, especially about, accelerating demand?
They really hammered home the efficiency of their carbonate platform, constantly mentioning that above 50% figure is a key differentiator. But the real hook, the thing that seemed to energize investors, was positioning their modular power blocks for data centers. The explosion in demand driven by AI, denser racks, the need for constant uptime.
Yeah, you can't escape that narrative right now.
No, and they called it a structural shift, reshaping global energy markets. They weren't shy about the scale of the opportunity.
Yeah.
And I think what's insightful isn't just that the market bought the AI story, but why FuelCell's specific approach might resonate.
Go on.
Well, unlike a lot of clean energy plays still figuring out grid integration, FuelCell offers this distributed behind-the-meter solution. It directly tackles the big headache for AI data centers. These huge, localized, absolute critical power needs that the existing grid just, well, it wasn't built for it.
So it positions them more as an infrastructure provider for the digital age, not just another utility supplier.
Exactly. That seems to be the pitch.
Okay, so tell us more about the specific moves then. Korea seems central. How important is that AnyVerse MOU? And what else are they doing on the data center front?
Korea is absolutely critical right now. They announced that Memorandum of Understanding, the MOU, with AnyVerse. It's to explore deploying up to 100 megawatts of fuel cell power starting in 2027.
100 megawatts is a lot.
It is, and it's potentially for what AnyVerse wants to be Korea's largest AI data center.
Yeah.
Now, an MOU isn't a firm contract yet, but it's a serious step.
Okay, a letter of intent, essentially.
Right. They also locked in a new LTSA with CGN for 10 megawatts that involves 8 carbonate modules. And they confirmed they delivered 8 replacement modules to GGE, with 8 more coming this quarter and 16 next fiscal year.
So building on an existing base there.
Definitely. They already have 82 modules. That's 108 megawatts, either installed or in backlog in Korea. And domestically in the U.S., they highlighted their partnership called Dedicated Power Partners.
Right.
That's with Diversified Energy and Tessiac.
Right, I remember that.
And the focus there is explicitly meeting that surging off-grid data center demand using their platforms. So multiple angles, but data centers are clearly front and center.
So why are fuel cells, specifically their carbonate platform, seen as such a good fit for data centers compared to, say, just more grid power or generators?
Well, a few key things. They have demonstrated utility scale platforms, 10, 20, even 50 megawatts that have shown, they say, more than 7 years of continuous runtime. So high reliability is point 1.
Critical for data centers.
Absolutely. Then there's efficiency, superior to traditional engines and turbines, they claim, and seamless integration. But maybe the most crucial bit is the thermal energy aspect.
The heat they produce.
Exactly. They can use that heat for absorption chilling. So for a 50-megawatt data center, they calculate they can provide 9,000 tons of chilling capacity. That offsets about 5 megawatts of mechanical cooling load and does it at roughly 70% efficiency.
So it's combined power and cooling. Very efficient.
Right. And being a behind-the-meter solution makes siting and permitting easier. Plus, low noise, negligible particulate emissions.
Yeah.
It all makes them pretty attractive, especially where grid connections are tough or slow.
Okay, makes sense. So tying this together, what about the broader environment, policy support, that kind of thing?
Yeah, there are significant U.S. policy tailwinds. The Inflation Reduction Act, what they call the One Big Beautiful Bill Act on the call.
Yeah.
That reinstated the full investment tax credit, the ITC, for fuel cells.
Yep.
And it runs through at least 2032, maybe 2035. That gives long-term visibility, which is huge for developers and investors.
Right, predictability helps.
Definitely.
Yeah.
And then there's the 45Q carbon capture incentive that helps support applications like their project with ExxonMobil. So these policies are, pretty concrete support for executing this strategy, especially while they're restructuring.
Speaking of ExxonMobil, what's the latest there? That sounds like a potentially big deal, the carbon capture collaboration.
Progress is continuing, is the official line. They're working with ExxonMobil's EM Tech and Esso Netherlands BV. The goal is a pilot plant using their carbon capture tech at Esso's Rotterdam manufacturing complex. They said they're in the conditioning phase for the carbon capture modules now. The project's expected to be operational sometime in 2026. Could be a real showcase for industrial carbon capture using fuel cells if it works out.
Interesting. Okay, so they've got the strategy, the market seems excited, there's policy support.
Yeah.
But what about the money to actually do all this? What's their financial foundation look like? Liquidity.
Good question. They closed the quarter with a pretty strong liquidity position, actually. $236.9 million in total cash, restricted cash, and short-term investments.
And how much of that is unrestricted, readily available?
$174.7 million in unrestricted cash. And that position was helped by raising about $38.1 million net proceeds from selling shares via their ATM.
They're at the market offering. Okay.
Yeah, they sold about 6.8 million shares that way. So while that cash gives them, a decent runway.
It's still a capital-intensive business.
Absolutely. And management acknowledged that. They said they're actively pursuing strategic financing too, especially for those Korea repowering projects and the U.S. opportunities through dedicated power partners. So they know they likely need more capital down the road.
Makes sense. And the backlog, did that show continued demand?
Yeah, the backlog increased slightly, up 4% year over year to $1.24 billion. So steady growth in the forward pipeline.
Okay, let's zoom out a bit. Connect this to the bigger picture for investors. This isn't just about FuelCell Energy's numbers, right? It reflects broader trends.
For sure. I mean, the whole clean energy sector is still pretty rate sensitive. We've seen elevated volatility. These capital-intensive models are getting repriced. You look at something like the ICLN Clean Energy ETF. It's only been modestly positive over the last year, up maybe 2.7%. Meanwhile, FuelCell Energy itself, before this latest jump, was down over 60% in that same period.
Wow. So that really begs the question.
Right.
Why did the stock rally so hard after these results when the broader sector is still kind of shaky? What made FuelCell stand out this time?
It really seems the market just grabbed onto that turnaround plus AI power demand narrative hard. Investors weren't just reacting to general AI hype. It felt more specific, focused on management's points about the carbonate platform's efficiency, and crucially, that unique fit for data centers. We talked about the reliability, uptime, the behind-the-meter aspect.
So future potential trumping current losses.
It appears so. Despite the big GAAP loss from those non-cash items, investors seemed willing to value the future growth story and the strategic execution. They're seeing it potentially as an infrastructure play for the AI boom, not just a struggling clean tech company.
Okay, looking ahead then, what are the crucial things investors should be watching for? What are the near-term catalysts that could show whether this rally has legs or if it was just, a one-off pop?
Good question. Key things to watch. Definitely Q4 order activity. They need to backfill that product backlog. Milestones on the Hartford PPA build-out project.
Right.
But probably most critical are updates on data center wins or pilot projects. Especially that AnyVerse MOU in Korea. Seeing that convert to a firm, substantial order would be huge validation.
Yeah, that feels like a major proof point.
Exactly. Also, more visibility on the EMD Rotterdam deliverables with ExxonMobil. And clarity on their capital roadmap, what happens after this ATM usage. Success in those areas, particularly real, tangible proof points on AI power demand, that's what's essential for this rally to continue.
And just quickly, their manufacturing capacity, can they actually build enough units if this demand surge really happens?
Right now, their Torrington, Connecticut facility is operating in the 30 to 40 megawatt per year range. Their target to get to adjusted EBITDA positive is an annualized production rate of 100 megawatts per year.
Okay, so they need to scale up significantly.
They do. The facility can eventually reach 200 megawatts, but that would need more capital investment. Importantly, management did note that the product gross margin, just looking at the product itself, excluding the factory overhead, is positive even at the current run rate.
So higher volume would directly help overall profitability by spreading those fixed costs.
Precisely.
Okay, so we've unpacked the numbers, the strategy. Naturally, thoughts turn to potential scenarios. Now, we have to stress, this is absolutely not financial advice, just a thought experiment. But what kind of, let's say, outrageous but plausible trade idea might someone brainstorm based on this AI power angle?
Right. Purely hypothetical educational brainstorming here. Well, given the market's clear excitement about AI power demand, fuel cell's strategic pivot, those partnerships. One idea, maybe leaning into the optimism, could be a long position using out-of-the-money call options, maybe expiring 12 to 18 months out.
Okay, why options and why that time frame?
Well, options give you leverage. The outrageous part isn't just using options, it's the bet you're implicitly making. That FuelCell doesn't just convert the AnyVerse MOU, but maybe lands another big data center deal, providing those proof points much faster and bigger than expected.
So betting on a rapid, significant re-rating triggered by major news flow.
Exactly. It's aggressive. Betting on the timing and size of wins that haven't happened yet, that's where the outrageous comes in, balanced by the plausibility of the underlying AI demand story.
Interesting. Okay, flip side. What about a more hedged or maybe even contrarian idea?
Sure. If you think the current rally is maybe too speculative, focusing too much on the story and not enough on the big GAAP losses or the capital needs, maybe you think the AI narrative is overdone for this specific company right now.
Right.
A possible pairs trade could be considered. You'd go short FuelCell Energy stock, but simultaneously go long a broader, maybe less volatile clean energy ETF, like ICLN.
Okay, what's the thinking there?
The plausible part is that if the sector continues to face headwinds from interest rates, or if FuelCell specifically stumbles on execution, maybe that AnyVerse deal stalls its stock might fall harder than the diversified ETF.
Isolating company-specific risk from the sector trend.
Right. The outrageous part is betting against a stock that has such strong momentum right now, based on a narrative that, while unproven, is undeniably compelling to the market. Yeah. You're betting the execution risk outweighs the story's current power.
Okay, two very different thought experiments there. And again, we have to stress.
Absolutely. Purely thought experiments. Educational purposes only, not investment advice. Please, always do your own thorough research.
Okay, so to recap everything. FuelCell Energy's latest quarter. Strong revenue growth, mainly from product deliveries. An improvement in adjusted financials, yes, but alongside significant restructuring charges and a large GAAP loss. And a very clear, compelling strategic pivot towards the high-growth data center market. That's backed by some notable partnerships, especially in Korea, and helpful policy tailwinds in the U.S.
Exactly. The long-term potential here really hinges on consistent execution. Can they deliver on these new strategies? Can they really capitalize on this accelerating global demand for clean, resilient, distributed power? Especially that behind-the-meter angle for data centers, that could be the game changer.
Well, thank you for joining us on this deep dive into FuelCell Energy's quarter. We hope this analysis gives you some valuable context as you form your own opinions and make your own decisions.
And remember, one last time, this is not financial advice. Always do your own homework.
We'll leave you with a final thought to chew on. As AI keeps growing exponentially, demanding just unprecedented amounts of power, often in very specific locations, will distributed generation, like the solutions FuelCell Energy is pushing, become the new standard for that kind of critical infrastructure? Or is it just a temporary fix for an overloaded grid? And if it is a fundamental shift, what does that mean for the entire energy sector and who else might benefit?